Hello again. In this video, I will be discussing discretionary versus systematic trading. Now, they are two totally different ways to look at the market. Systematic trading is when you have a trading system that says when one thing happens, you're supposed to do something else. So, for example, and I'll go ahead and put an example of um, a potential trading system on the chart. Go ahead and make that orange red. And I'll do another moving average, and this one I'll make blue. Okay, so one of the most common trading systems is the moving average crossover system. So, for example, you have two moving averages, and one crosses over the other. The red goes above the blue, and you buy. And as you can see, and you keep it until it crosses back over. As you can see, it would have worked really well in this situation. But on the other hand, it chops around and you get a couple crosses here that would have at best been break even, probably cost you a few pips here and there. But now we're in a move that seems to be pretty profitable, at least so far. So that's one example of systematic trading. The signal happens and you just take the trade, period. Discretionary would look at other things, possibly, such as maybe there was a news announcement somewhere in this time frame that would keep you out of the market. Um, Discretionary can also be very just kind of random trading, really. You look at this, you recognize on the weekly chart we're in a downtrend, so you just sell. That's potential uh, discretionary trading. The reality is, you'll hear both of these terms, but even systematic traders are somewhat discretionary in the sense that if you get a signal to buy or sell and it's 5 minutes before non farm payroll announcements come out, most traders will avoid that. So there is a certain amount of discretion put into each trading decision. Plus, there's also the fact that systematic trading kind of implies an automatic type of trading, and then you could be talking about expert advisors or what they call robots, and that of course takes discretion out of the picture completely. Overall, if your system over time proves itself to be profitable, you can do either, but discretion allows you to override in a situation where you may find yourself in trouble. Truthfully, you kind of want to use both. Typically, most traders do. You try to be as systematic as possible, but you obviously don't want to make really dumb choices. Again, for example, going into a CFD market for the S&P 500 right before non-farm payroll. That's a classic time when you don't want to be putting a new position into the market. Um, Again, though, like I said, in this downtrend, you could have sold in, assuming that none of your stop losses got hit. Maybe you didn't even have one. That's another way to trade with discretion. You just kind of watch the trade and get out when you want to. The problem with that, of course, is while you're sleeping, something horrific could happen to your account. But these are things that some traders do, or they'll back them up with options. They'll go ahead and let the trade run. And if they're selling, for example, the Aussie yen, they might buy calls on the Aussie yen just in case we get a wicked reversal. So there's a couple different ways to look at this. Truthfully, systems do tend to give you a framework from which to make decisions, but obviously you have to press the button. So in a sense, you're always going to be doing a little bit of both.